Welcome to our webinar on the three biggest killers in retirement: risk, fees, and taxes. I'm Daniel Rasvi. I'm a tax attorney, and this is
Carlos Vasquez, certified financial planner. So Daniel, let's get right into it, right? So for 30 years I've been doing this. You always hear that the more risk you take, the better the reward. Is that always the case?
That's not always the case. Sometimes less risk actually gives you a better result. It's sometimes true, no risk, no reward, and sometimes actually less risk is better.
Right. So it's not always true. And how about fees? You know, the number's always 1%. Sometimes advisors feel like they're doing you a favor if they're charging you 1%. But that 1% can add up, right?
Yeah, we're going to show you how even a 1% fee can eat away 31% of your growth over time.
So 1 equals really 30%, right? It can get high.
Exactly.
And the last one, of course, is taxes. If we help a client, what type of savings are they looking at if we're able to work with them?
Well, most of our clients will save over $1 million in taxes by working with us. So we are able to save. Those are the three killers: risk, fees, and taxes. And I have a quick, funny video about taxes here.
Ben, where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses.
But it's okay. It's part of the game.
No, it's not.
It
It's not fun.
It's not fun to what?
It's the worst part of the game.
It's what?
Taxes.
Taxes, the worst part of the game. So we'll try to get you a better perspective on taxes. Hopefully it won't be so terrifying for you. But really it's all three of these big killers in retirement. So first of all, let me introduce myself. I'm with my family on the left side of the screen there. I'm the oldest of 13 children. This is me and my father, Raz, who's the founder of the firm. And this is Carlos. This is your family, right?
And I'm trying to catch up with just two on the right, but the day is young. We have these are my two bosses, more or less, as I like to call them.
And I also have my wife and two kids. I'm just getting started as well. I have a long way to go to catch up to my father with 13 children. And when we're not doing retirement planning and legal estate planning and tax advice, my family and I have a Conquered by Love Ministries, which is an adoption and parenting ministry where we strengthen family relationships, especially with adopted children. We speak all over the country, myself and my parents, on those types of topics. So you can check us out there, conqueredbylove.org. And we have two companies for retirement planning. We have Higher Ground Financial Group, that's where Carlos is, and Higher Ground Legal, that's my law firm, for the estate planning and the tax advice and so on. We're 100% virtual. So all of our client meetings, they're always on Zoom or Google Meet. We don't do any in-person meetings. That allows us to have frequent meetings with our clients that are even very short, bite-sized chunks, so we can meet with many different people. So if you have an interest, you can click the link and make an appointment with us to learn more about how to reduce risk, fees, and taxes. You might have also seen us on one of these publications. I've written a bunch of articles, and I'm frequently here on the radio and the TV and so on. So
being virtual allows us to talk to anybody in the country, right?
Exactly. So we have clients all over the country as well. We can give you tax advice anywhere. And what do we really do for our clients?
Right. So I guess the biggest thing is help reduce taxes, right? Everybody, whether you're paying 20% or 30%, if we can help you reduce taxes, that'd be great. Reduce the risk, right? If we're able to reduce the risk that you're taking to get a similar return, that's a big deal. But how do we do this?
Well, if we get rid of those three killers, risk, fees, and taxes, that helps increase everything else, right? Retirement income, you have more protection, you can leave a better legacy. Most of our clients retire with 50% more income than they thought they would have in retirement several years early. Now, we are fiduciaries. That means everything that we discuss with you must be in your best interest at all times, except for this webinar. This is not fiduciary advice. It's specific, not specific advice for you. It's general information that's meant to be educational, and hopefully you'll get some good information out of this. But to get fiduciary advice, you need to contact us directly to get that. And when we put together a plan for our clients, we want to show you what a difference it makes with us versus without us.
Right now, out there on your own, your life expectancy is like here. With me, it's here. Without me, here. With me, without me. With me, without me. So, I wouldn't advise going home, but it's up to you.
So you're the Tom Cruise in this scenario.
Exactly. It's a very funny movie, night and day, but not your life expectancy, but your money's life expectancy. We want your money to last as long as possible. So anybody recognize this guy? You can put in the comments if you recognized him. This is Data, the android from Star Trek. I'm a huge Star Trek fan,
You
and
can
I
tell.
love Star Trek. And because I'm a huge Star Trek fan, that first picture, I already knew this was Data, the android from Star Trek. Now, Carlos, you're not such a big Star Trek
I'm a
fan.
Star Wars fan for those Star Wars fans out there.
So for you, the first picture was only insufficient data.
Right.
Yeah, insufficient data, it leads to poor choices, and there's more jokes like that where that came from. We want to give you complete data and complete information to make good decisions about your money. So we talk about taxes.
Yeah.
Everybody wants to lower taxes, but what is a tax really?
Well, a tax really is any heavy or ordinance demand on your resources, right? So we all know about federal taxes, state taxes, but those aren't the only taxes we really pay, are they?
No, there's really three types of tax, right? You have the market tax. You know, if there's a loss in a bear market, we have a market crash, that's just like a big tax. And it's actually worse because you don't get anything for it. At least with federal state taxes, hopefully you get some roads and bridges or something else you might be happy with. I know there's a lot of things you're not happy with, but you know, some things you might be happy with. But with market tax, there's nothing that you get for that. And then the advisor tax is the fees you pay. So you're paying this fee every year to your advisor. Hopefully you're getting something for it, but it is a tax that on your money, an onerous demand on your resources.
So 30% doesn't matter where you're paying it, one way or the other, right? So
Exactly.
So what are we looking at? This looks like a tin can, right?
Yeah, so what's the history behind the tin can?
Well, I'm a big history buff, and what I can tell you basically is that Napoleon was a guy that really loved his generals. He loved his armies, right? But he knew in order to march across Europe, he needed food, right?
Mm-hmm.
Well, he had a contest to basically say, how do I make sure that we preserve this food? And the contest was, I think, the equivalent of $15,000 for somebody that could come up with a way to preserve it. So that's the idea of the tin can, except that this is what it looked like back then, right?
Exactly. But it preserved food. It did the job.
So it did.
But there's something missing, right? What was missing?
What was missing is to open this thing, you need a hammer, you need a whole bunch of other things. The can opener doesn't get invented for a half a century later. So what are we saying? Are we the can opener in this scenario?
Exactly. So all your money you've been putting away, all your life you've been putting away money in your 401k, your IRA, your TSP, 403b. You've been saving money into this tin can, and now we want to help you get it out with the least amount of spoilage from those three killers: risk, fees, and taxes.
So if you don't know what you're doing, basically you can spoil some of your money.
Exactly. You need the proper can opener so you can get the can open with not spoiling the food. So our agenda for today, we're going to focus on those three killers: risk, fees, and taxes. We may or may not get time for questions on this broadcast, but you can certainly put a question in the comments and we'll get to it either at the end or afterward. We'll email you or something like that. So again, we're going to talk also about estate planning and how that fits into taxes right at the end. And let's start with market updates. So we're coming off in 2023 and 2024 were two really good years for the market.
And that's what we talk about, right? Everyone talks about, I had a great year in 23, I had a great year in 24. What's the year they don't mention?
They don't mention the one right before, right?
Yeah.
Which is 2022, we had a big loss. And in fact, more recently, people are concerned with tariffs and other things. The market's been dropping, then it comes back, then it drops and comes back. There's a lot of uncertainty. But 2023 and 2024 were very good years. But the last time that happened was the dot-com bubble, 1998. So, like you said, people have forgotten. Just a few years ago, we had this bear market of almost 20% loss at the end of the year. Now, it actually was down almost 25%, but it came back right at the end of the year. So it was down almost 20%, and then we had a 24% gain, then a 23% gain, but the average for all three of those is still only 24%.
Yeah.
So what is that like if you average that out?
You're looking at a little over 7%, 7.26 to be exact, right?
So, I mean, that's still pretty good,
Yeah.
but it's not the 23% that you remember
Correct.
getting. And a lot of people kind of miss that. We remember the good years because we want to remember those, and we kind of forget the bad years.
It's human intuition, right?
So when is the next crash coming? Well, we don't really know, but we know there's going to be good years and bad years in the future. You need to be able to plan for both of those.
Correct.
Okay? And Carlos, over the last few years, the people have been trying to move to bonds because bonds are supposed to be safer, but that has not worked so well in a rising interest rate environment. So
It's been unpredictable at best, right? So basically, what happens is, these bonds are becoming due, and the government basically isn't spending any less money. They're going to keep spending more money. So when you go to renew these, right, that's going to be an issue for a lot of these folks.
Yeah, and especially if interest rates keep going up. That makes it harder to refinance those bonds. It makes it harder on the debt. But what we've seen is when interest rates are higher, now your bonds you're holding are not worth as much. And so that causes the bond market to crash. So we've seen a lot of problems in the bond market. It's not as safe as people thought it was. It could still do well, especially if interest rates drop, then the bonds you're holding now might be worth more. But we'll have to wait and see how that goes. It's not protected from loss like people thought it was.
Right.
Now this is the federal funds.
It kind of looks like the market when you first look at it, right?
Yeah, from 2000 to 2022, you got all those crashes, right? The dot-com crash and the 2008 crash. But this is not the market?
It's not.
So what is this?
So basically, it's telling us what the Federal Reserve had done, right? And the question is always, well, does the Federal Reserve lower rates and that causes the market to crash, or the other way around? We're not really sure, right?
But they do happen together, right?
They do.
So you notice the federal funds rate drops when the market drops. And we cut it off here at the end of 2022 on purpose because it's been very uncertain since then. They've kind of held rates, go up a little bit, go down a little bit. They have not had a huge drop. And that's what we're waiting to see. And we'll probably see that at the same time as the market has a big drop. The drop in the beginning of 2025 was not a really big drop at first. It was only down about 10-15%, then it came back, and obviously it's been very volatile all this time, but we're really looking for our next crash of 30-40%, and I'll tell you why that is the expectation.
And people think, why do they get involved? Well, the problem is if they don't, you have runaway inflation, which could be an even bigger problem.
Yep, and there's all these risk factors. Even before the new administration came into office, we have all these things that are predicted to be causing some market uncertainty, and especially this consumer anxiety about housing. The housing market is doing terrible right now. There's so much demand, and people can't afford the houses even if they want them or need them because of interest rates and the prices. So it's very, very difficult to get ahead, especially the housing market. Now, what's also causing some problems is the commercial real estate. So tell us what's going on with that.
Well, I can tell you that about a year or so ago, I was still going into work and to an office building, right? And you realize that after COVID, basically the occupancy of these buildings was down to like 25%. So 75% of the space was empty, right? And you say, well, why do I care? How does that affect me? Well, it affects all of us. Right?
Yeah, because we hold investments, and if you have money in the bank, a lot of the regional bank holdings are in that Class A office commercial real estate. A lot of hedge funds are invested in commercial real estate. So as those values of the properties are going down because nobody's going back to work on a nationwide level. There are some limited areas that are going back into office, but most people, if they can work from home, they want to do that. And that's causing a massive drop in the value of this commercial real estate.
Somebody not going to work affects your 401k.
Exactly. Now, this guy, Warren Buffett, $325 billion in cash at one recent time period. I don't know the exact number today, but it's very close to that anyway.
So what does that tell us?
He's got more money in cash than in the market. And he missed the last couple of years of big market growth because he is expecting a crash. Yep. But more importantly than that, Warren Buffett understands the most important thing about investing. You know what Warren Buffett's rule number 1 for investing is?
Don't lose money.
Don't lose money. And then rule number 2 is never forget rule number 1. Right. Don't lose money. That is so important especially when you're retired. Even if you're not trying to buy a new business like Warren Buffett likes to buy new businesses, if you're retired or you're going to be retired, you need money on the sidelines that you always have access to in case the market crashes. And we don't know when it's going to crash, but we do know there will be good and bad years. Eventually the market goes up, but what happens in the short term? If you get a cut on your arm and blood is gushing out, and we rush you to the hospital, and the doctor gets ready to stitch you up, and then before he stitches you up, he says, no, let's get the blood off the floor and put the blood back in your arm, and then we can stitch you up.
Well, that sounds so simple, but I can tell you that over 30 years, that's exactly what clients will say, right? If they lose money, they'll say, Carlos, can we just wait till the market bounces back up, right? And then I'll do something.
And then when the market's up, they're like, oh, it's doing well. I don't want to do anything now. So you need to kind of separate yourself from the ups and downs, the short-term swings in the market. Yeah. Figure out, do you have enough money to actually sustain the income you need in retirement? And if you do, why are you taking risk? If you already have enough money, if you've already won the game, and if you don't know if you've won the game or not, click the link, make an appointment with us. We'll be happy to do a video call with you to talk to you about how you can reduce risk, fees, and taxes, get an income plan for retirement.
That's where the 101 comes in, right?
Exactly. So This is the actual market. We showed the Federal Reserve rates before, but this is the actual market from 2000 to 2022. It was a 22-year period. And again, we chose this time because it did end higher if you're writing it out. But what happens in the meantime? It went down, went up, went down, went up. Eventually, it went up high. So what do you think was the average return? Think about it. And if you know, put it in the comments. What was the average rate of return for that 22-year period?
Seems like 12%. It seems to be the number that everybody wants to write in. Right?
Exactly. But most people say 12%, or maybe they say 8%. They say, well, I mean, I know I had those crashes, so it must have been something closer to 8% or 7%. No, it was actually 4.28%. It's crazy. How is it only 4% average return for 22 years? And you might be thinking, oh, these guys are crazy. I know I got better return than that in the past. Well, you probably did. Why did you get a better return? Well, you were saving money for the last 22, 25 years. So count up all the money in your 401k. Most of it is the money you put in and the employer matched.
It went up because you were putting money in.
Exactly. Exactly. And what happened? We lost 50% in the dot-com bubble. And then how much do you have to gain to break even?
Well, I think people are going to say 50%, but not.
It's not
probably
quite
not the right answer.
No, if you lose 50%, you have to gain 100% just to break even. And then we lost 50% in 2008. We had to gain 100% just to break even. So for the first 13 years of this century, there's zero return. Now remember the three killers: risk, fees, taxes. We have not even gotten to the second two. Just the first one, we have zero return. If you count fees and taxes, you actually lost money. But then after that, it did really well. The average was still only 4.28. Now, if you knew this ahead of time, what could you have done? You could have gotten a treasury, right?
Right.
6.86% in January of 2000. So if you did that, then what would you have? Let's say you had $1 million in 2000.
So basically, if you had $1 million and you invested it and put it in the treasury, you would have had 3.7 without the heartache and aggravation, right?
Compared to only $2.4 million with the market risk. I mean, so the solution, it sounds like the solution to all your problems is when you get home today, sell everything you own and buy 20-year treasuries.
Not what we're saying.
No. But what you should take away from this is look, not risk and reward are not always linked. Sometimes it is just fine to not have risk. In this case, the least risky thing you possibly could do, beat the market by like 50% over that time.
Correct.
So it's a huge deal to protect from losses. Now, you might be thinking you're kind of like this puppy that someone has taught to play the shell game, and your advisor is hiding the ball. Can you find the treat?
He'll find
the return.
Of course he'll find it.
Oh, you found the return. Good for you. And now look what you could have had. Oh, my goodness. And now watch carefully. Yep, there you go. Spits it out. I don't want that anymore. And this is what we feel like when we've been chasing these returns, chasing this return that we can get, and we don't realize sometimes just stepping back, reducing those three killers, risk, fees, taxes, gives you so much more wealth, so much more income. And so we'll keep talking about that as we go on.
We don't know what we don't know, right?
And a lot of people say, you just picked the perfect time in history to make your point.
Well, we had to pick something, right?
No, well, let's look at other time periods. So this is every single 15-year period since 1996. Mm-hmm. And we put on a year, you take off a year, put on a year, take off a year.
So right out of the gate, one thing that we see is that there was only one 15-year period where it was over 8%, right?
Yeah, right here near the end, this 2007-2021 period, only one time was it over 8% average return. 4 times it was under 3% average return.
So what was the average?
It was crazy. And if you go back even further, first of all, this is the average of 5% for all those periods. But if you go back further, remember that 13-year period of zero returns?
Seems like a long time, right?
Yeah. Before that, there was a 26-year period of zero returns. Before that, there was a 52-year period
News
of zero
keeps
returns.
getting worse.
Oh, yeah. And now this was inflation adjusted. So you put $1 in. After 52 years, you can still only spend $1 worth of buying power. And that's crazy. So why in the world did anybody ever invest in the stock market?
Well, I think people used to invest more for dividends, right? So the idea is that the dividend is really what you were concerned about, the income from these investments. But that changed with the advent of a 401k or something. Exactly.
So the dividends are not included on here, and it's very intentional to show you that most of market history, the dividends actually are one of the biggest drivers. Yeah. And ever since the 401k started and became popular, the companies realized people are going to buy our stock every 2 weeks of their paycheck. It doesn't matter if we pay a dividend. So a lot of them don't pay nearly the dividend that they did in the past. Dividend stocks still exist. So if you want consistent income in retirement, that is one way to achieve that. And many of our clients have done that and been successful with that. But you got to look for it because most stocks don't pay dividends that they used to.
It's all about growth.
And keep in mind, dividends are also not guaranteed. So they could slash it even if they pay one now. So we're talking about bear markets and market crashes. And this is every single market crash since 1929. And what's interesting to you about this chart?
Well, number one is basically how often they happen, right? So we're saying that basically every 5 years or so, they're going to last about a year and a half.
So I don't lose all my money in one day?
No, it's not overnight. That's the problem. It gradually happens, so we don't even feel it. But if you're looking at the average loss is 39%.
That's crazy. So 39% loss. And if you have that kind of loss, it usually takes several years to recover. In fact, this paper from Brigham Young University is saying you only have a 61% chance of just breaking even over 5 years if you don't touch the money. And here is the problem, right? If you're watching this, you're probably either approaching retirement or you're already retired. When you're in the accumulation phase and you're just saving money for someday in the future, and someday is a far long way off, then it doesn't matter because you're not going to spend the money in the near future. But if you're retired, you have to spend money every year. And you can't afford to wait 5 years for the market to come back after a crash. You need money that's not subject to this, right? So what do? You diversify.
That's what everybody says.
Carlos,
the conventional wisdom is, invest money. So basically, if you had all your goods in a boat, you have more boats, right? Put more money in different boats.
So now I'm diversified. I got 5 more boats. I'm diversified.
Well, the problem is they're all boats, right?
So if there's a tsunami and it comes, then they're all affected.
Correct.
Right? So what is true diversification?
So basically, true diversification is when you look at the different types of assets, right? So you have opinion-based assets and you have contract-based assets. And what most of us know is opinion-based assets. So that would be the market, right? A foreign leader basically decides that they want their part of their country back. That's going to affect the markets, right? It affects my 401k. When you look at Zillow, you see that the value of your house goes up and down.
But I think my house is worth $1 million,
right?
And you're only willing to pay $800,000 for it.
That's all opinion.
But it's not my opinion. It's somebody else's opinion,
correct.
Right? It's whatever somebody else is willing to pay for my asset today.
So what's a contract-based asset?
So contract is the opposite of that. Contract, you know what you have. So imagine if you have $100,000 in your bank account, and then you go to the bank and they say, "Well, Trump tweeted today, so you only have $90,000." Well, no. The market or politics or anything, none of that affects what you have in the bank because it's a contract. If you have 100,000 in there today, you got 100,000 tomorrow plus whatever interest they guarantee. And there's other contract-based assets. There's contracts with insurance companies. There's contracts just between individuals, like a rental contract, for example. So if you have a rental property, it's kind of a mixture because the property value is opinion-based, but the rental income is a contract. And that's why we really like our clients to have real estate in retirement, but not if you're just hoping it goes up in the future, because you can't spend that. What you can spend is the income, and contractually you're going to have it. So it's important also to know that the contract is as good as whoever's writing it. If you get somebody that's not going to pay the rent, then that's not a good contract. But it still is a contract.
At least they're not paying you what their opinion of that rent for that month would be, right?
Exactly. They don't get to choose the rent. It's what it is. So you need to have diversity between opinion and contract assets, and then you also need tax diversification, which we'll get to in just a minute. Again, insufficient data leads to bad decisions. I'm, again, a Star Trek fan, so I like Star Trek jokes. Anyway, so besides risk, the next one is fees, right? And Carlos, in your experience, clients usually pay about 1% to their financial advisor.
Yeah, and again, the advisor makes them feel like he's doing them a favor, she's doing them a favor, but the 1% is just what's stated, right? What you don't see is the internal expenses that are paying. Like the person that's actually managing the money is also going to charge a fee.
And then you have the mutual fund expenses. You have trading costs, cash drag, all these. These are not our numbers. These are New York Times and Forbes. They found on average clients are paying quite a bit more than the 1% fee.
Yeah.
And when we do an analysis for our clients, they see these webinars and then they sign up for the free call by clicking the link below. We find that they're often paying at least 2 or 3% of fees, even if they thought they were only paying 1%.
Correct. So this says it can be as high as 5%, but on average, they really are paying up to 3%.
Yeah, it's crazy. But let's say you already did this analysis and you're only paying 1%. How bad is a 1% fee really? So Carlos, let's say you have $500,000 to invest with me.
Yep.
Okay. And you say, what can you do for me? I'm going to give you 5% return. That's more than the market. Market only did 4.28. I'm going to give you 5%, and it's going to be guaranteed. It's going to be a contract, in fact. And so now you're going to get $1.2 million of total growth over the next 25 years. Does that sound good?
That's good to me.
Okay, now for that, I should earn a reasonable fee. I'm going to earn, it's just 1% though. Just 1%.
But did I pay you on the 500,000 I didn't even make for it?
Exactly. So the 500,000 that you already had, you have to pay a fee on that too every year, and on the growth every year. So it's going to be higher every year. So after 25 years, you end up paying $217,000 in fees.
Does the advisor waive it on years that the market goes down?
No, most times you paid anyway, right? So that's not all. What happens if you pay all those fees to me? Then where is that money? Whose account is it in?
Right, it's money that you could have invested. So you gave that up.
So you gave that money up, and all that lost opportunity cost is another $159,000.
Now we're way over 300,000. Right?
Exactly, your $376,000 that you lost to only a 1% fee. And if we count that out of the 1.2 million of growth that you got, really that means 31% of your growth went away to fees.
That's real money.
Not 1%. 31%.
1% equals 31. That's the number we want to remember, right?
And again, you know, not all fees are bad, but you really need to put a dollar amount on it and know exactly what you're paying in fees. And then you need to decide, why am I paying an advisor? What am I getting that is worth $376,000 in this case? And what are they doing? Are they beating the market for you? Well, most advisors do not beat the market. If you look historically, I think the studies show 95% of managed accounts do not beat the S&P. So what else are they providing? Are they giving you peace of mind? Are they giving you a written income plan? You know, and you're confident how much you can spend each year. Again, most people that we run across are not getting that. Maybe they're getting tax advice. Does your advisor give you advice on Roth conversions and other things? Or do they talk about it, and then they send you an email, and the email signature says, this is not tax advice, this is not legal advice, consult a proper who? Tax attorney.
Tax attorney. Talk to
So
Daniel, right?
this is who I am, and so our emails and our disclosures say this is tax advice when it's fiduciary advice to you, it's specific tax and legal advice for you, and we want to give you those confident income plans that you know how much you're going to be able to spend without running out of money.
31% in fees is just as bad as 31% in taxes, right?
Exactly. So here's Bob and Carol, a case study. These are clients of ours, not their real names. If you're watching this and you're Bob or Carol, this is not you, it's somebody else. And they have pensions and Social Security, but Carlos, they had all these assets, 1.6 million, and they weren't spending this because they wanted to. They wanted to spend, they wanted to travel, but they're worried. They're worried about the market being high, money running out, taxes, fees, all these things. So what were we able to do with them?
So what we can do, one of the things that you find out, number one, is what they're paying in fees, right? So all together, they paid $49,000 in fees. That's
crazy.
It's a college tuition. The advisor's a college kid, by the way, not your kid.
And then on top of that, not only were they paying $49,000 every year in fees, even though they thought they were only paying 1%, they were paying 3%. Yeah. They were also exposed to a $790,000 potential loss in the next bear market.
That's the real problem.
And that's the huge thing, because now they have to gain 97% just to break even without spending any money. And that's why they were afraid to spend and use this money. So we were able to reduce their risk and their fees. We reduced it by $32,000 a year savings, so more than $300,000 of savings just over the next 10 years. Then we reduced their risk, so now they know the worst market crash, they're only going to lose $150,000.
And to get that back, they don't need 97%. They only need 10%.
Only 10%. So now they can definitely have more confidence, less stress around retirement, and if you're less stressed, you're also going to live longer. You're going to enjoy your money longer as well.
That's real peace of mind.
So now we get to taxes, right? The three biggest killers are risk, fees, and taxes. Yeah. We want to understand the recent tax law changes, the ones that are being proposed, but specifically what's going on and avoiding the political. So I'm not going to talk about whether the people that are in power should be or whether they're doing a good job or a bad job, but only what is already happening and what looks like it's about to pass. Okay? So first of all, you will pay taxes. Resistance is futile.
Can't get away from it, right?
You can't get away from that. And this is a good thing, though. I know it's a scary picture up there. Again, with the Star Trek reference. It's a scary picture up there, but the reason I put it there like that is it flipped the script. You are in control. You can choose when to pay the tax. If you already agree you're going to pay the taxes, you can choose to pay them on your terms rather than the government's terms.
And today, when you know what the terms are, right?
Taxes are on sale right now,
yeah.
Right? So let's forget taxes for a minute. Let's say, Carlos, you and I are going to start a business, all right? In fact, you're going to be the one that starts the business. You're going to do all the work. I'm not going to put any of the money, any of the equity or anything, but you're working hard, you're making money at this business, and then I come along and I'm Uncle Sam's nephew, Guido, and I say, Carlos, this business you're running, it's a nice business. You owe me 10%. That's my cut.
Why exactly?
Well, protection. I keep you safe. I give you
Protection I didn't ask for.
the military and the police and all these other things. I keep you safe for 10%. You got to pay me.
Okay.
Okay. So
Doesn't sound like I have a choice.
no, it doesn't. And then a few years go by, and now I come back and Carlos, you're doing really well. You're making even more money. My cut's now 20%. And I keep coming back every couple of years. Oh, now it's 25%. I get to change the rules. If I'm Uncle Sam's nephew, Guido, I get to change the rules anytime I want. You don't want that kind of deal with the government. If you have any money in an IRA, a 401k, a TSP, this is tax deferred money. That means you have that deal. You say, Uncle Sam, I know what this tax would be if I paid it, but I'm not going to pay it. You choose whatever you want me to pay 30 years from now, that's what I'll pay. That is a terrible strategy, especially in the uncertain times that are coming in for retirement. So taxes are on sale right now. We want to get out from under the IRS as soon as possible, and they are scheduled to increase in 2026. Now, there's been a lot of talk about the tax bill that's going to be passed. A lot of these rates may get extended, and if so, that'd be helpful for Roth conversions and other things. But at least we know they won't be worse than this year. The 12 is scheduled to go to 15, 22 go up to 25, and so on, 24 to 28. Most people have heard of this happening, but they have not heard that the brackets themselves will be shrinking. So if nothing gets passed ultimately, then the tax brackets are all going to shrink. Look at this rate on only 24%.
So it looks like somebody that was making $300,000, that would have changed from 24 to 28. That doesn't seem like that much of a difference.
I mean, it's a decent difference, but worse is the bracket ends at 282,000.
Yeah.
So you lose more than $100,000 of room in that bracket. So not only would you go up one bracket, you probably go up two brackets if you have that size income. So many people are not aware of that. And that's a huge increase. It's like a 35% increase in taxes if you go just from 24 to 33. On that extra $100,000, that's a 35% increase, roughly. So we definitely want to pay tax at the lower rates if we can. So yeah, you want to fill up those brackets as much as possible. Now, besides income tax, there's also capital gains tax. Now, Carlos, are you always going to pay 15 or 20%?
No, that's what people think. Like you're going to pay on the first dollar, but basically up to $96,700, you don't pay capital gains, and even then, you're only paying 15%.
Exactly, and it's even better than that because if you're married, you have a $30,000 roughly standard deduction. So you could have more than $120,000 of income. Let's say half of it's Social Security and the other half is capital gains, and then you have a whole bunch of Roth income that doesn't even count, or other tax-free sources. So you could have completely 0% tax and still be making $200,000-$300,000 of actual money in retirement. And we have clients that are doing that. They're retired, they're earning $300,000 a year and paying no tax. It's all legal because they took steps ahead of time to make their assets in the right spot for tax diversification. So the real tax system is more complicated than just the brackets. If all there is the brackets, you can just Google those. You don't need a tax attorney for the brackets. But what we help with is navigating this changing environment in retirement. We have required distributions, Social Security, Medicare premiums, all these things come into play. And I don't have another slide on Medicare, so I want to stop and talk about it really briefly. So people talk to me, and you asked me at the beginning, how much do we save on taxes? Normally we save over $1 million in taxes for our clients. Right. But then they say, well, if I'm going to do Roth conversions, I'm going to be in a higher bracket for Medicare, and I'm going to pay $400 a month more for Medicare. Why would I do that intentionally? Well, the reason is it's so much less than the actual tax savings. I do want you to pay less in taxes, less in Medicare costs, but we want to look at the overall picture. If you're going to save over $1 million in taxes, and one of the consequences is for a couple of years you pay a couple $100 a month more for Medicare, that's a fine trade-off. Eventually it'll go back down once the conversions are done.
Now this might be a good point also to point out. Most people will say I have a CPA. What's the difference between a CPA and a tax attorney?
Well, a CPA is you should have a CPA. CPAs are great, but they are short-term thinkers, and I'm a long-term thinker. So generally speaking, a CPA is going to tell you, here's how much to pay in tax, make sure you don't get in trouble, file the right forms, and if you ask them, how do I save money on tax, the CPA will normally say, well, you can defer. Put more in the IRA or the 401k, that'll lower the taxes. It doesn't lower it so much as it just pushes it to another year, and the other year is likely to be worse. It's a big myth that, I'm going to be in a lower bracket when I retire. You don't want to be in a lower bracket when you retire. That only happens if you're poor when you retire. Because think about it. The amount of money you're spending now, at the age you are now, do you want to go back to the lifestyle you had 25 or 30 years ago at the beginning of your career when you retire? No, you want to keep the same lifestyle. Yeah. And if you could, You want to keep the same lifestyle, which means you got to spend the same amount of money, which means your income's coming from, if it's coming from IRA, it's all taxable, so you pay the same or higher taxes. So when the CPA says defer, that's a short-term play. I think long-term, I want to see how can you reduce taxes over your lifetime. I really couldn't care less how much you pay this year. I care to save money over the long term for you. Okay, so let's talk about required distributions. What are RMDs?
So basically, the government's going to say at age 73, for most people listening to this, you have to take money out. They let you deduct this. It grew tax free, right? So eventually they're saying we want our money. So very simple scenarios. You have $1 million. You divide it by 26.5.
Why 26.5?
It's your life expectancy. Somehow they know to the day that you're going to die.
Okay.
Right?
So if you're 73, they say you're going to die in 26.5 years.
26 and a half, right? So
Okay.
that number's 37,736.
And it gets bigger every year, right? Because you
Right.
divide by a smaller number.
So the math works. If you divide by a smaller number, you get a bigger number. So basically, by 120, you got to take out half the money. And if you don't, you just pay a little 50% penalty.
Okay.
That's it.
All right, and you can give the RMD, by the way, to charity too. It's called a QCD, Qualified Charitable Distribution. You can give up to $105,000 a year there if you like charities. That's one way to not pay tax. But if you want to keep it for your family, we got some other ideas for you coming up. So tell me about phantom gains. You know, a lot of people, they lost money because of the tariffs, and they're going to get a 1099 for income or capital gains tax, even though they lost money. They didn't even sell anything. So how does that happen?
You pay taxes on money you never made. So basically what happens is the advisor might sell a highly appreciated holding, right? Which could be a good thing. It's not necessarily a bad thing. But they don't pay the taxes for you. The taxes just gets passed on to you.
So this is not IRAs, by the way. This is your non-qualified, your brokerage accounts.
Correct.
Create phantom gains.
You could have, they might rebalance that portfolio, which again, they're supposed to do. But again, that creates taxable gains for you.
And if you could avoid it, if you know ahead of time, there are some ways to avoid that. But they can also cause a cascading effect on other things. So we'll talk about that. Now this 3.8% in net investment income tax, this is another tax. A lot of people are not even aware of it.
It's only tax on the rich, isn't it?
Yeah, that's why I say the rich. Well, you can decide for yourself if you think $250,000 of married couple income in a major metro area should be considered rich, but that's what they count it as. And this is one tax that might actually be easy for them to increase. They can say, look, we extend the rates, we kept the rates low, but we're going to change this to 5 or 6%. And it's only affecting the wealthy people, so you don't have to worry about it. So watch for that to change potentially. But right now it's 3.8%, and it's just on top of everything that you have above that threshold or on your capital gains income. Then there's Social Security. You have a choice of anywhere from 62 to 70 to start Social Security. And you can put in the comments what you think and what people have heard of what the optimal time to start Social Security is. And it's different for everybody. But most people hear from most advisors and on the media that you should wait as long as possible because you're going to get more the longer you wait.
Yeah.
And I mean, it's true you get more the longer you wait, but there's also some downsides to that. So in our firm, we often tell our clients actually take it as soon as possible. Why should you take it as soon as possible? First of all, what do I mean by as soon as possible? Well, you have 66 or 67, that's your full retirement age. You want to make sure you wait till then because otherwise you're not allowed to work and earn more than $23,000 of income. Yep. So if you're under 67, you have to either retire to take it or you got to work until 67, then you can take Social Security. But you don't need to wait till 70. And the reason why, there's actually 3 reasons why. First of all, it's a tax reason. When I first heard Social Security was taxed, I was so mad because it's a tax coming out of my paycheck every week, and I got to pay tax again when I receive it. And it's crazy, but that's what it is. And this is how they tax it: 50% of Social Security plus all these other incomes, even non-taxable interest like muni bonds, that counts against you for Social Security. And it's crazy.
Money you've been told you were never going to pay taxes.
Exactly. So when you're above a certain threshold, all that provisional income, if it's above $44,000 for a married couple, 85% of Social Security will be taxable. That means 15% of it is always tax-free. Now, I know many of you are wondering about this proposal that the Trump administration has for no tax on Social Security. And there are a lot of things that are making it into this tax bill, but the Social Security is one that is probably not going to make it in. And the reason is because of the rules around reconciliation and the way they can vote with just 51 votes in the Senate, they cannot add or change anything with Social Security taxes with that specific 51 vote majority. They have to have 60 votes for that. So what they're going to do instead, it looks like, is going to add a higher standard deduction for people that are of Social Security age. So it's going to have a similar effect, of reducing the taxes you pay in Social Security without actually changing the calculation on this piece. So this piece is going to stay about the same, it looks like, for the time being. And the way that is calculated, let's use an example. So Carlos, let's say you need $60,000 to live. Let's say that you are married and you have a Social Security. You could each take $20,000 of Social Security.
Yep.
So, but you're going to choose to let your wife's Social Security grow, and you're going to take your $20,000. Now you need $40,000 out of your IRA because you need the $60,000 to live.
So I'm taking more money from the IRA than the Social Security.
Exactly. But now your wife's Social Security can grow, so you'll get more later, right?
Which is what most people think to do.
When we calculate that, you're going to have a provisional income of $50,000. That means your total taxable benefit's only $11,000. Now I'm going to retire in the same year. My wife and I will both take Social Security, so that reduces the strain on our IRAs. We only need $20,000 out of the IRA because we have $40,000 for Social Security. My provisional income is also less, which means my taxable benefit's less. If you're confused, don't worry. We'll say it slower to you when we do the meeting with you, and we'll use your numbers rather than this example, okay? But let's look at the difference. Carlos, because he only took one Social Security instead of two, he pays $2,500 in taxes. I pay $0 in taxes, and I have more room in my standard deduction, so I could actually take out $2,600 more. I could be $5,000 richer every single year that I take Social Security before you do.
So taking more money out of Social Security reduce your taxes.
Exactly. Now here's another reason. If you retire with the most Social Security you can qualify for after maxing out the income stuff, $2,500 a month is what you'll get at 62. Waiting until 70, you'll get $4,500 a month. So that's more. It's like almost $2,000 a month more. So that's why they say to wait. But what do you miss? You miss the $2,500 you could have gotten for 96 months. That is a $246,000 loss.
$250,000.
Now you are going to make more eventually, so you'll get it back someday, but it takes you all the way to age 80 just to break even.
So I have to promise to live to be 80?
Exactly. And it's worse than that, because if you didn't really need it, you could have invested it. Or you could take it, like my example, and let your investments keep growing. So let's use an opportunity cost of 6%. Now your loss is $315,000. Now your break-even point is age 83. Now, Carlos, if you're an American age 62 today, what is your average life expectancy?
I'm going to guess 83.
Exactly. It is 83. The Social Security Department is doing this on purpose. They want to give you the same exact amount of money no matter when you take it if you live to an average age.
Yep.
So if you live well into your 90s or more, maybe it could be good to wait. But on average, it's going to be exactly the same amount of money, not counting taxes and not counting inflation. Last year in 2024, the Social Security retirees got 3.2% increase for inflation. Please comment below if you are sure the inflation rate was really only 3.2% last year. No, I don't think it was. I think most people experience more inflation personally than that. Yeah. And so that should tell you that today's dollars are worth more than tomorrow's dollars for Social Security. So why is it that everybody here take Social Security, wait as long as possible instead of taking it now? It's because that's advice is for the average person, right?
Yeah. And again, look, there are circumstances where, but it's rare, and it's that person that says, well, Carlos, I can work, I can keep working, and I'll get $4,000, close to $5,000.
And especially
especially
if you don't have much money saved,
yeah.
If you don't have other money to draw from in retirement, then Social Security is your only check, and you want that to be as big as possible. But if you are above average in income and wealth, you have $500,000, $1 million, $2 million, $5 million saved for retirement or more, then Social Security is not your biggest check in retirement. It's one of the smaller checks. And in that case, you have the opportunity to do things differently that not everybody can do. So John and Jane married, filing jointly, 73. They've got $60,000 of Social Security, $15,000 of capital gains, $45,000 of required distributions because they turned 73. We put them through our tax calculator. We found that they thought they were paying 12%, which is the red line down there, but they're actually paying 49.95% on part of the money.
What cost that?
It's crazy because they took the $1,000 required distribution. That should have caused 12% taxes, and it did, but that caused $850 of Social Security to become taxable, also at 12% for $102. That caused $1,850 of capital gains to become taxable at 15% for $277. So the total tax burden on just the $1,000 withdrawal, $499.50.
And is that the $499 that we're pointing at? We're pointing at the 49.95, right? Almost 50%.
Exactly. So even though they only took out $1,000 required distribution, or that first $1,000, it caused that much in taxes because of the cascading effect. Yep. And that's the difference between working with a CPA and a tax attorney. We give you this ahead of time, try to minimize it for the future. This is a funny quote on Twitter.
Yeah, so basically, Jeff is trying to explain to his son how taxes work, and he basically says, "Listen, I'm going to give you a bag of M&Ms, and you got to give me a certain amount back, and if you don't, you're going to jail, right?"
And you have to guess how much,
Yeah.
right? And it's crazy. So what can you do if you are not the average person? If you have higher than average net worth, and you have some money saved, what can you do? You diversify. We talked about contract and opinion assets, diversifying, but there's also diversifying among account types for taxes. Don't have all your money in tax deferred accounts like IRAs, 401ks. You want Roth, you want other non-qualified, you want other types of tax-free accounts, real estate. All these are taxed differently. That way you can blend the withdrawals from different accounts depending on what you need each year. Now, also you want to think about which assets should be held in which account type.
So one of the things sometimes you hear on the radio or TV, people talk about self-directed IRAs, which again sounds sexy, and people will talk about putting real estate. Is that ever a good idea?
No, it's not a great idea to put self-directed IRA in real estate. And here's why. Well, again, I like real estate, but you need to make sure you get it right. Because when you're in a self-directed IRA, you have to pay high management costs, custodian fees, you got to get it appraised every now and then. And what happens when you need a new roof on the property? You can't contribute more than $7,000 or $8,000 into the IRA, so you got to borrow. Well, you can't get a loan because most banks don't lend to IRAs. Even the ones that do have a higher interest rate. So it's a mess. And then the worst part is all the benefits of real estate, the tax-free income because of depreciation. You die and leave it to the kids. They pay no tax if they sell it, and they can depreciate it all over again. All of that is gone if it's inside of an IRA. So I like real estate for retirement clients, but not inside of an IRA.
Get all the pain, none of the gain. Huh?
And the other thing people often get backwards is annuities. They hear, it might be a good idea to sell my stock and buy an annuity because I'll be safe and protected. It'll give me guarantees and so on. Well, that could be a really bad idea. And the reason is, think about it. If you take your Microsoft stock that will be a capital gain and you sell it, you didn't have to pay capital gains, but now you're paying it. And then you buy this annuity, which will grow and give you income tax in the future, which is worse than capital gains. So if you decide that there's an annuity that's going to protect you, then use your IRA for it. And most people don't realize that, but you can use an IRA or a 401k for an annuity. It's still an IRA. So there's no tax on that transaction. Later, the income comes out, it's already taxable, but it already was taxable. So there's no new tax you've created by doing that.
So it could be a good idea. You just got to make sure that you know what you're doing.
Exactly. Whatever the investment is, don't just think, is this investment right for me? But also, how can I tax it the best way? And we talk about RMDs. We're going to talk about Roth conversions and CRUTs. So what are Roth conversions? First of all, what is a Roth IRA as intended of a regular IRA?
Right. So basically, the idea was that you could, the Roth IRAs, that you pull the money tax-free, which sounds great, right? So we should all put money into a Roth IRA, but the government said, nah, you make too much money.
Exactly. So there's the income caps on Roth IRAs where you basically you pay the tax now on the seed and not the harvest. And so there's other ways around it if you want, you're still working, but let's say you're already retired or you're about to be retired. How can you take advantage of Roth conversions? There's no income cap. You can take money that's IRA and make it Roth without
Anybody can convert.
Anybody can do that. Now there are 2 5-year rules to be aware of. So what are those?
So the first is that you can't take you have to wait 5 years or 59 and a half to access the principal.
So if you're
one or the other.
If you're over 60, then you still got to wait 5 years before you can access the growth that happens after you convert.
Right.
So let's say you convert 100,000 to Roth today, and then 2 years from now it's worth 120,000. Well, you can spend the 100,000, but you still got to wait 3 more years before you touch that 20,000 of growth because that's the rule for the Roth conversion. But it's not very restrictive. You can still do it, and there's no RMDs.
That's the big deal.
Big deal. If you don't want to spend the money, you don't have to. So take advantage of the new tax laws. Sometimes it's better to pay a little bit more tax now than to pay a lot more later. How much more later? Well, thank you for asking because I have a slide on that too. And this is a client of ours. She has $1 million in her IRA that she's not going to spend because she has a pension, the Social Security. That's enough for her. She wants to leave this to her daughter. And we calculate she's actually going to pay over $500,000 in taxes over her lifetime by keeping this IRA. Just on the required distributions. Then she's going to pay another $200,000 in reinvestment tax because she doesn't need the money. Then when she dies, her daughter's going to pay another $400,000 in tax. So the total that she and her daughter pay are like $1.1 million.
It's more than the value of the
exactly.
Actual.
Now converting to Roth or to life insurance, either one of those will be tax-free options. There's no other tax after the first tax, $300,000. That's it. No more tax on growth. No more tax at death. And on the left side of the page, I was assuming that tax rates never go up for the rest of her life, which is probably a bad assumption. On the right side, it doesn't affect you. Once you've paid it, that's it. They can change the tax to whatever they want, and it doesn't affect you.
But I still got to come up with 300,000 though.
Okay, so let's give you an idea how to do that. So let's use something called a CRUT, a Charitable Remainder Unit Trust. So if you have some highly appreciated stocks or depreciated rental property, we want to give you an opportunity to put this someplace and not pay the capital gains, deferred indefinitely, by donating it to a charitable trust. Now you get a giant tax deduction. It could be 50% of the balance that you could put in or more, depending on your age. And then you get a pension for the rest of your life coming out of this trust. Now, the downside, if you don't like charity so much, is whatever's left in there has to go to charity when you die. And now, if you don't like any particular charity, you can set up your own charity. It is legal to donate to your own charity as long as it's set up properly and it really is doing charitable work.
So those are the foundations.
Those are family foundations or other types of things. You can certainly do that, or you can just give it to your church. Let's use an example and see what the tax benefits are. So this is a client. She has, $500,000 of Apple stock that she bought when it was like $2 a share, and now it's all capital gains. So if she sells this, she's going to pay over $100,000 in capital gains. And she thinks, well, I got to sell. I don't think Apple's going to do too well because of the China tariffs and all that. So I'm going to sell. Now's a good time. And I don't want to pay the capital gains, so I'm going to donate it to the trust first. Then I'm going to get a $222,000 charitable deduction. I'm going to sell the stock. The trust was going to sell the stock with no capital gains at all. We're going to take the deduction, the $222,000, over to the IRA and make the IRA tax-free by converting to Roth, and you're not even paying taxes to do that. Then she's going to get $25,000 income, a pension from this for the rest of her life. Now, she is paying tax on that. But she tells us, look, I don't need this money. But I'm a little bummed about my kids were going to get this $500,000 of stock. And I'm happy that my church is going to get it now, but I still like the kids to get something. Right. So what do? We take the $25,000 a year and we buy life insurance for $1 million death benefit. So now when she dies, the church gets $500,000 tax-free. The kids get $1 million tax-free from the life insurance. They also get the Roth IRA, the 222 and whatever that grew to, maybe $1 million also over that time, also tax-free.
So mom won, daughter won. Somebody must have lost.
The IRS lost. Everybody wins except for the IRS, and it's crazy how it works. But this is a very unique and useful strategy. It has been around for a long time. It's not a new strategy, but a lot of advisors don't talk with their clients about it unless you have $50 million of assets. And we think there's a good streamlined way to do it, even for smaller and more average-sized clients as well. All right, so take a quick guess. It's a poll. How high have taxes been historically? What do you think? I know I'm going to give you the answer in just a second, but don't cheat. Put it in the comments and tell me what you think it was. It was actually 94% was the highest rate we've ever had in this country. So we are in a very low bracket right now. And the interesting thing is, look at the rate on only $10,000 of income. Yeah. Back then, at that time in the 40s, it was 40%. That's a really big takeaway. Even if you are in a lower bracket in retirement, the bracket itself could be higher.
All brackets go up.
All the brackets could be higher, and that could cause a major problem.
The other thing with the graph, too, is that basically you look at, there's almost a 50-year period where the highest tax bracket was over 70. Forget 94, that seems really high, and it happens during war. But almost for 50 years, it was still over 70%.
It's crazy. And so we are in a very low environment now. And it might have made sense in the 70s and 80s to defer tax at a high rate in order to pay a low rate later. But we're in a low rate now. Now is the time to pay the tax so you don't pay a higher rate later. Again, the insufficient data causes undue stress. I don't want you to be stressed. I want to give you the tools to be stress-free in retirement, which is to reduce the 3 stress causers: risk, fees, and taxes. Okay, now let's talk about estate tax real quick. And again, if you want to make an appointment with us, you click the link in the description to make the appointment. We'll be happy to talk to you about how to reduce your risk, fees, and taxes. So if you want to think about estate taxes, there's also, this year, the exclusion is only 13.9 million. It's a really high exclusion. So this year is a great year to die for estate purposes. I don't mean you really die. I mean, you can pretend to die for the sake of estate planning. Right. You can give your money to certain types of trusts and avoid a 40% tax on excess, because those rates are, or the thresholds are set to drop. Gift tax is the same. A lot of people know you can give $19,000 away per beneficiary. That's not the limit. That's just how much you can give without reporting it.
So it's not a pain.
So you can give more. You just have to report it. You still don't pay any tax. And then there's different types of wills and trusts. You should have a trust because the trust, it bypasses probate and it goes outside of that court process. Then there's irrevocable trusts that you may need or may not need, depending on your situation. We can talk about all those when you make an appointment with us. One thing I will say here is beneficiary designations trump everything. So what does that mean?
That's such a common thing. Like, suppose you're part of the 50% and you have an ex-spouse and you leave your ex-spouse as the beneficiary because, quite frankly, you just forgot.
So they got half the money in the divorce, and then when you die, they get the other half.
Yeah.
Because you never changed the beneficiary.
It doesn't matter how much fancy planning you do, that trumps everything.
So make sure that matches your will and your trust.
Yep.
And then great things to leave to your kids: real estate, primary residence, rental properties. All these are great. There's a stepped up basis. They pay no capital gains, and they pay no capital gains to inherit the stocks from you either. So these are good things to leave to the kids.
Yep. What are bad things?
The bad thing will be IRAs. Do not leave an IRA to your kids. Either spend it all while you're alive or convert it to tax-free, either Roth or life insurance. Both of these are the best things, most smooth, most tax-free, most efficient ways to leave to the kids. The inherited IRA is a problem because they have to spend all the money within 10 years, pay all the tax within 10 years. Yep. You cannot stretch the IRA anymore. And then this is why I say you should have a trust, but not just have a trust. The trust should also say what to do with the house. Because imagine if you leave your house to your kids, even through a trust, these are your 3 happy kids, and he wants to sell, he wants to rent it, and she wants to move in, and now these are your 3 happy, loving kids. So we want to avoid this. So your trust should say the house must be sold, or the house may not be sold, but you should decide and not the kids so they don't fight about it. Mm-hmm. We talked about market risk, other tax. We didn't talk about long-term care, but we can answer those questions if you have them later. Inflation is another risk. Then there's boomerang children. What's that about?
So basically, kids come back, and not only do they come back, they bring back their wives, their kids.
So if you want a solution to boomerang children, the kids won't move back home if they can't find it. And we also sell RVs on the side. No, not really. But there's an idea there for you. So on that note, if you say, okay, this makes sense, let's at least have a conversation. What is that process to reach higher ground? With our firm, we have a 4-step process. Yep. So stage 1, we get to know you. It is, if you click the link and make an appointment, it is a Zoom call, it's a video call.
And it's free.
It is free, so there's no charge. We'll talk to you, understand where you're coming from, and we also, not just English, if you're a Spanish speaker, that works as well.
Hablo Español.
Yes, so we can talk to you either way, and it's a free call. There's no call or no cost for that, and if you want to go to stage 2 and actually get a plan, we'll put together a plan, a tax plan, a risk analysis, a fee analysis, an income plan. We'll discuss estate planning. We'll look at all your documents, and we'll give you specific recommendations on how to reduce those 3 killers: risk, fees, and taxes. It will be a fiduciary plan. Now that's a $6,000 value. It's only $500 for those of you who are watching this webinar, and you get that, you're eligible for that. If you select and make the appointment for the free call, then you'll be eligible for that $500 offer for that analysis. You're going to meet with me, the tax attorney, at least 2 or 3 times to make sure that you can get all your questions answered on the taxes as well. And then,
what if I don't want to take your advice?
So now you have 3 options. Once you've done this, you have 3 options. Option number 1 is, this is terrible, I want my money back. That's fine. We have a money back guarantee. Number 2 is, this is great, but I have my own advisor. I don't want to leave them. I want to keep everything with the current advisor. That's fine too. Most of our clients actually have another advisor also. They don't do everything with us. But even if you want to do everything with somebody else, that's fine. You'll still have all the information. We won't hold anything back. We'll give you all the tools. And then option number 3 is, this is great, and thank you for bringing it to my attention. I want to use your firm, and I want to work with you. So then we talk about what products and services you could do through our firm, and whether it makes sense to do some small changes or some big changes, and what will be the best for that.
So we can and will implement the plan if the client wants it.
Exactly, right? So we want to get you to the place where you can really say this.
With me, without me. With me, without me. With you.
So much more charming when she says it.
And so if you're watching this on a computer and you want to take out your phone and scan this link, you can scan this link there. But you can also click the link in the description and make the appointment as well. I see that there's some people that have questions in the chat, but we'll have to get to those at the end because we're out of time now. But make the appointment. We'll be happy to talk to you about how to reduce those 3 killers: risk, fees, and taxes. Once again, I'm Daniel Rasby. I'm the tax attorney.
Carlos Vasquez.
And we'll talk to you soon.
Hasta luego.